traditionally, of course, we're the investor for offices, retail, logistics, and on the commercial side of the bracket. But I hate to break it to the players in the niche markets. It's going to get more crowded potentially. So you better hurry up and try to spin it out more expensively to us. Or we may just bully our way in and push you to the side. But we're not that quick. So it's your quick and nimble that will keep you in those markets. Present markets in Germany, again, as you can hear, the majority of the developers are concentrating on the residential market. That has the effect that office developments are very low at the moment. Potentially maybe leave Berlin out of that picture, but in general, I think it's 50% of the typical development pipeline in Germany. You have vacancy rates in the bigger cities of under 5%, around 5%, which is a critical size for rental growth to take place, which is then potentially coming through. It always seems to come through in everybody else's assets, not ours. So we still price that relatively cautiously and conservatively. Rental growth seems to be something on a chart. Before you get it in your assets themselves, due to the fact that you have longer lease terms in Germany, indexed rents, and very low vacancy in our buildings at the moment, you're not really tapping into that growth. But due to the fact that there's very little supply, it will come through. And no matter where the crisis or if the underlying economics change, there's a certain risk buffer in there somewhere before it starts hitting your valuation. So that's the nice thing about low development pipelines at the moment. The bad thing is that as an investor, on the other hand, we're trying to get our hands on the according new, shiny, well-developed, rack-rented, presently rented assets, and that's become a rare, very rare good, which becomes a very crowded marketplace. And you're pricing in the full development risk, even if you go in early, and it becomes something that is extremely attractive to a lot of capital in the market, and makes it very difficult for us to be able to be competitive there, even us with our very low cost of capital. So the office market is sound, it's solid, at say 1.5%, 1.9% in Germany. If that growth continues, you've got a solid pickup. Numbers don't really change. So I think it's an attractive good for Germany. Retail, again, development pipeline, shopping centers is extremely low. I don't think it's ever been this low at all. Which I think is a good thing, because spending money on more stuff, who the hell that nobody needs, it'll go somewhere else, I think. You need to omni-channel, your online, your logistics, city-close logistics areas are going to improve, and they're going to be willing to pay more to deliver their goods directly to the consumer. I think there's a limit to the growth in high street retail presently, especially if rents increase on the longer picture. Your consumer spending will have to reduce to compensate your cost of living to a certain extent. And the cost of living in cities, in an urbanization world that we have, will continue. So I think there's a limit to growth scenarios, and plus the tenants will be looking at high street retails more as a flagship store without having to actually make money, but presentation. Which again, if they're not making any transaction on that, they won't be able to pay as high rent. So that may be a weaker market. Logistics strong, office strong, retail stable, but not in the same growth scenario as it has been in the past. Still something to look at, and again, very rare. In the European context, all those demographics and all that fundamentals for Germany are strong. And without having to go through every city or any other markets in Europe at the moment, it's become a very small market for us, at least. It's a very competitive market. A lot of countries are critical to look at. Very little assets coming out of it, at least for a core plus buyer. The added value side might be stronger, or more able to see things that we can't see on the growth side or on the yield depression side at the end of that cycle. We're very mature on the investment cycle, and in my view, and I said this 2 or 3 years ago, concentrate on your income side for the next coming years, because I think that yield cycle, no matter how cheap money will come to an end to a certain extent over all the asset classes.